So we've seen global equities, they sold off from March into April, and now they've recouped around half of the losses that they made since the March low. Do you think we are, well, I mean, I suppose, do we head higher from here? Is there enough solid information to trade on to take us higher, or do we remain nervous around a second spike, around trade tensions, and see reasons to sell risk assets?
I think we're probably going to be at least in consolidation and probably with a little bit more volatility in the coming weeks, because we've priced in a lot of the good news already, and especially a lot of the stimulus. And of course, markets are looking forward. They're looking to 2021, but there's still a lot of question marks about 2020. And at some point, I think the rally is going to stall. Now, given the size of the rebound, and given that it is quite consensus that we are going to get this second leg down, it might not be as strong on the way down as what we might have expected a month ago, but at some point volatility is going to pick up.
So what kind of second leg down? What kind of size are you seeing?
Well, I think there are two different views. There's the view that the rally has been because people were worried they were missing out, and that's why it's continued so much. And then there's the view that people have missed this rally, so as you see a fall, they're going to buy the dip. So I'd say anywhere 10 or so %. I just don't think we go back to the March 23 lows.
Esty, we saw reports from the White House yesterday that they were taking measures to stop government pension funds, government retirement funds in the United States from investing in Chinese stocks. This is just the latest round in tensions, I suppose, which had been very much on the back burner and have now really stepped up once again between China and the United States. Are you watching that trade deal that was signed at the start of this year and just hoping it doesn't unravel ahead of the election in November? How focused are you on trade, given we're dealing with the virus globally?
Well, I think that we've seen actually in the last few weeks when these trade headlines have popped up, you've seen some of the bigger market reactions. So that's definitely something we need to keep an eye on. There was hope at the beginning that you'd have more coordinated global support and that it might actually help with the trade relations, that they might ease a little further because we're pretty much all in the same boat. But what we've seen in recent weeks, it's actually been the opposite, and tensions have been exacerbated. So we are keeping an eye on the trade deal. I'm not sure if it's this first phase that was signed that's really in question. And I don't think that tariffs are the way the U.S. would respond and the smartest way for the U.S. to respond, given everything the U.S. economy is already facing. But I definitely think from a sentiment perspective, this trade situation is going to remain on investors' minds, and it could be one of the catalysts that sort of leans sentiment a little bit more fragile, a little more bearish than what we've seen recently. Because if you're projecting forward, if you're thinking about risks to this trade deal, if you start to think about the U.S. election, granted it's still quite a few months away, but obviously the situation could deteriorate, especially if Trump gets reelected.
I wonder what you think, Esty, though, still in terms of U.S. stocks. I mean, the question of the day on the MLive blog is, do you prefer the U.S.? Do you prefer Asia? Do you prefer Europe? And we were talking with Steen Jacobsen earlier, who said the U.S. has the advantage of these mega caps. There's no trillion-dollar companies here. And they're what's driving sentiment right now. What do you think?
I agree. I mean, when you look at the number of stocks that are actually pulling the market up, it is a lot of these stocks. It's a lot of technology. It's biotech. Those stocks, I think, are going to continue because it's going to take a long time to get back to normal. And a lot of these companies were pretty much already set up for this work from home or this stay at home spending. So their growth patterns are going to be much more secure, I'd say, than a lot of other areas. So valuations, of course, are rich. That hasn't stopped the rally in the past. So I'd agree, especially on a sort of even medium-term basis, that the U.S. is likely to outperform. And what we're seeing in the short term is you want to maybe be part of this rally. We think it's a bit early. We want to be a bit more cautious still. But if you wanted to be part of this rally, what investors are doing is focusing on growth, focusing on defensive, focusing on quality, And I think that gives an advantage to the U.S.